This is the More Doors podcast. We are back with episode 67, or in today's cool language, 67. We have an amazing guest from Aligned Ventures. Super excited to talk to him today. We'll be back with Tyler and a really rich content show right after this. All right, everybody. Welcome back to the More Doors podcast. We are here with episode 67. Before we get into introducing our guests and having a great conversation about some acquisitions they recently made. What's up, Jesse? Jesse's rocking it. Tor Studios. If you don't know about Tor Studios, do yourself a favor. Go check out my boy Jesse at torstudios.com, T-O-R-E studios.com. Jesse's got a whole bunch of podcasts that he's been absolutely unleashing here over the course of the last couple of years. Great guy. Small businesses of America, go support them. Tell Jesse you heard about him on the More Doors podcast, and he'll make sure he charges you as much as possible. So thanks for doing that for our guest, Jesse. Appreciate you. Also want to give a big nod to Deep Blue Capital, show's sponsor. Check us out at deepbluere.com. Check out the portfolio, newsletter, all the things, and hit the subscribe button on all the socials where you see the show. It definitely helps us from a rankings perspective and helps us get great guests like the one I'm about to introduce. So without any further ado, I want to introduce Tyler Evans from Aligned Ventures. How you doing, Tyler?
I'm good, Matt. Yeah. Pleasure to be on the podcast, man.
It's great to have you, man. It's great to have you. Definitely looking forward to this conversation. For the folks that don't know you, Tyler, or you or Aligned Ventures, tell us a little bit about yourself and what you got going on in Aligned Ventures, if you don't mind.
Yeah, absolutely. So myself personally, I've been in multifamily for 18, 19 years now. I come from the operational side of the business. I was running portfolios for a lot of years, got into the ownership side, decided stop making all the money for everybody else and try to make some for myself. So I've been with Aligned. This is 6 years. It's my partner and I. What we do here at Aligned is we do existing value-add multifamily deals. We focus on the Houston and the Dallas market specifically. So that's what we're doing out there.
That's awesome. That's awesome. What types of asset classes do you guys typically look at in Houston and DFW?
Yeah, we started, 2020, 2021, going after C-class value add. That's where a lot of the guys start. You kind of pick up what's left. You go in, you put in the hard work, you bring them back to life. Now we've graduated. We're doing more 250 unit B-class deals in better markets. We really like the B space right now, just where everything's at.
Nice. How are you guys defining B, if you don't mind?
B, I would say B is like an 85 to early to mid 2000s, depending on condition and build amenities. Obviously your A class, you're going to see top tier rents, top tier amenities. The stuff that all the they fight over. Best in class. And B is what used to be nice, aged out a little bit, still a great place to live. But it actually has amenities where you see, typically bare bones, renter by necessity type situation.
Yeah, totally. So, that's where my partner and I cut our teeth too. We've been in C class, for a long time. We acquired a B asset, a little over, actually just coming up on 2 years ago now.
Nice.
What was it about C-Class and specifically value-add C-Class that appealed to you and your partner?
Well, yeah, I think it's a great asset. It continues to be because they are renters by necessity, workforce housing, right? So you always have a base there. It's not going anywhere. And I think there's always a lot of value there. A lot of times you'll find these deals with mom and pop owners, there's no institutional operations to it. So they leave a lot on the table. You find the right deal. Obviously the basis going in is huge as well, right? You're getting into it, you're not taking down $20 million deals. You come in, you find a nice, $8 million asset, and you're able to really go in and make it your own and figure out who you are and what your how you're going to turn these assets around. So there's opportunity there.
Totally, totally. Yeah, and the C class appealed to us for the same reason. At least here in Dallas, uh, the C class market 5 years ago was super hot, right? And
Was.
so as a result, we have all our assets, and they're performing, but it's been challenging over the last couple of years, right?
Yeah.
That period from like 2021 through late 2023, when money was just out there and people were moving around and they didn't really care about the rent increases. It was play money. But now that same kind of demographic is hurting, and we've seen flat, overall flat rents probably now for the last 2 years, if not down slightly. We've had to make some adjustments to security deposits. We're probably less hesitant to just non-renew residents and have to put
Yep.
money back into make ready. So we're renewing more of those residents where we can. And then you got insurance and taxes that went through the roof. So how have you and how's Align Ventures kind of managed that perfect storm of stuff over the last couple of years in the workforce housing space? Because I know we felt it.
Yeah, no, absolutely. We've seen the same things, just a whole tightening of that space, and really the only thing you can do is shore up your operations,
Mm.
right? Because you're not raising rents, and you do have to keep more of the people. So, but I think the most important thing that we've done is not open the floodgates, maintain your standards.
Mm.
Right. And I've seen some comps in our markets do that, where occupancy starts dropping and they get desperate and they just let anybody in, and it's a domino effect, right? Your good tenants are now harassed by the bad ones. They leave, and, then your whole property is worse than it was before. So, what we've done is we've tried to take advantage of those properties, making those bad decisions, and take their good residents who are ready to leave.
Mm.
So having good specials and ready to take those people, find those struggling properties and say, hey, I know it's bad over here. If you're leaving, your lease is up, come see us, and making sure they qualify in all the ways, criminal, evictions, credit, all those.
Mhm.
So that allows us to maintain a really strong base. And then within that, just being very conscious of all the operating expenses,
Mhm.
turns, contracts, say, hey, I know it's been a year. You've been consistent as our landscape guy, but we're going to get bids. This guy says he could do it for 20% less. We're thinking about trying. Do you want to meet his price? And a
Yep.
lot of times we're finding people agreeing to that, which is allowing us to keep our NOI strong.
Love that. Love that. Yeah, I mean, for the first time in a while, so far this year, we've actually seen cost reductions in a number of ways. We're about to renew insurance on a property with a 50% year-over-year reduction in insurance, which is
Wow.
awesome. We successfully adjudicated our property taxes last year. We're getting ready to do it again this year. But to your point, right, I think there's some vendors out there that have realized that there's certainly a pinch going on, and they either lose the business or they come down a couple of bucks, and the smart ones are reducing by a couple of bucks
Yeah.
to keep loyal customers, right?
Yeah, you get that relationship, and it's like, I don't want to go to a new guy. I know you do a great job. I'd love to keep you. Like, help us out.
Yeah.
Right. Everybody was, like you said, in, 21, 22, it was just a free for all.
Yeah.
Everybody raised all their prices. Everything got more expensive. And now everybody's looking at it and like, okay, we got to, be a little bit more reasonable here.
Agreed. So, Tyler, are you guys vertically integrated given your background in property management?
We are. We have a couple assets. We tried to go third party. That was a plan. It's hard to find a good third party out there, and
Yeah.
for me, given my background, it was like torture. I'm like, man, these guys aren't doing this, they're not doing that. Property started underperforming. We actually just, let them go. And then I just took it over, built it out. And so we do have a functioning management company that runs those assets. On our newest acquisition, though, we did hire a new third party, one that's, Houston based. We've had a relationship with. So far, they're off to a great start, because until you reach a certain scale, it's really difficult and takes a lot of bandwidth to do in-house. So I think, ultimately it's great to have a vertically integrated management company, but you really need 1,000 doors or more to make it function, efficiently.
Mm, yeah, agreed. Good point. Well, let's segue to the new acquisition, if you don't mind. I'm really excited about digging in on this, and I've heard a lot. I haven't heard a lot of deals closing, but the ones that I have, right, there's always seems to be a
Yeah.
story with them. So, what you guys recently made an acquisition? Tell us a little bit about it, if you don't mind.
Yeah. So we underwrote a ton of deals. I think 150 deals. We were best and final on about 8. And out of all those deals, this one is the one that we like the most.
Mm.
So it's 200 units in West Houston, Katy Market Energy Corridor. So that's something that's super important for us right now. It's just market location, right? They're not all created equal. You can get a great deal in a bad market. It doesn't matter how good of an operator you are. You're not going to be able to rise above a certain level.
Yeah.
So we're really specific, and this market checks all the boxes. You got, 100K plus median incomes, A plus schools, huge diversification of employers. So, we love all that about it. One thing that is really interesting, so this is an 84 build deal, but it flooded in 2017 with a hurricane.
Sure.
So they filed a multi-million-dollar insurance claim, gutted the units, from the studs up. So you got windows, electrical, plumbing, granite counters, new cabinets, beautiful job. But the best thing is it's not in a flood zone. It was because the city released the floodgates to save downtown. And so it went out to the suburbs. This property's never flooded before. It's not in a flood zone. So, your insurance rates, you're able to keep them low. We obviously carried flood insurance just in case, right?
Of course.
But we bought this at a 1980s price, but effectively the age is 2017, new roofs, 2020 or newer, new paint, everything on this deal is, 2017 or newer. So, structurally, when you buy an 80s product, you always have to worry about, what's your CapEx going to be?
Mhm.
What am I going to have to fix, this and that? With this asset, it really kind of ease those concerns because you have, verifiable dates of purchase on almost everything. So that was great. The best part about this asset, though, and the way the market is that this is an operational play. It's not a renovation play. We're not coming in, dumping millions of dollars and jacking the rents up. We bought this from a $1 billion fund. They had, Gray Stars managing it, just, big operation. And when we saw it, we saw that they left a lot on the table as far as operational savings. So we were able to come in, acquire this, and day one start making those savings. So, payroll for a 200 unit property was way over what it should have been. We're able to save 90K day one, straight to the NOI.
Nice.
You mentioned insurance reductions, and I agree wholeheartedly. And surprisingly, we were able to save 250 grand over their in place.
Wow.
Annually. Yeah. Big cut. So 50% almost. And I actually, I have my vendors that I love that I've used on a lot of deals, and I thought they had the best price, right? I was like, wow, this is a really good price. But I went out there and I kept shopping. Guy I'd never done a deal with, I'm like, hey, give it a shot. Here's what I have. He was able to save another 50 grand annually on top of that. And that's big savings, right? That impacts your NOI directly. So I think, insurance is a great opportunity right now for all the owners out there. Don't be stuck with your same guy. Try somebody new, shop it around. There's a lot of carriers in there. And we are seeing big reductions right now. So, the fund we bought it from had, basically feel good affordability component to it. Mm-hmm. So, it's just something they mandated. 25% of the units had about a 7% discount, just to, feel good. So the day we bought the property, that ended. So now we're just bringing them up to rent, which it's priced well within the market. It's not top of the market. It's right in the middle. So we feel really good about that. But that increases value about $1 million just by taking that loss to lease out.
Yeah.
So really, go ahead.
Just between what you said about payroll and insurance, right? That's $340,000 at a 5 cap.
Yeah.
It's, almost $7 million worth of value.
Exactly. Right. Yeah. So we're able to come in. We've already executed those. So Amazing. We've already really raised the value. We haven't spent a dime, and then the other thing is bulk internet. Right now they have Comcast in place. average tenants paying about $60 for, the coax. So we were able to negotiate a deal with them where we're getting fiber 1 gig to each unit. And, we're going to make about $25 per unit per month in revenue on that. So we're signing that contract this week, and that's just a huge, another almost $1 million revenue, well, not revenue, but value driver at a 5.5 cap. So,
That's
and
awesome.
that's really the bulk of it, honestly. So it's just one of those deals that we saw a clear path, because I think in the economy right now, you have to be very cautious in how you're going to add value to these deals, because, A class, B class, or C class, it's tight out there for everybody. Gas is expensive, groceries are expensive. So when you say, I'm going to increase, this rent $200, that really has an impact on their real life every month. Maybe now they can't go out to eat anymore. So that might make them want to go to a more affordable place. So we're very cautious when implementing things. So like with the internet, for example, I'm going to be able to give that to them for $55. So it's faster speed, less than the average that they're paying now. So that's something that they should be welcoming, and say, oh, great, I love fast internet and I love paying less every month. So it's a value driver for us where we're just becoming the supplier versus, some big company. So I think you have to be very selective on the value adds that you're bringing and make sure that it really is a value to that resident. Because if you add too many of those and it's not a value, I think you're going to see your overall occupancy drop in this environment.
Yeah, I completely agree with you. And I think one of the things you hit on there, right? You're doing good for your residents, and you're profiting from that. And to me, I think that's fully okay compared to where we were 3+ years ago, where everything was an extra fee, right? There was the amenity fee and the pool fee, and this, before you know it, there was a few $100s a month in fees. And I think if you just treat people properly and help them save money and help them create a great place to live, that you're going to increase your resident retention. And if you can make a couple of bucks through renewing residents and things like the bulk internet, then you should, right?
Exactly. It's a win-win situation. That's what you got to look for. So
Absolutely.
You're right. Things got out of control with all the fees, and like, what is this fee for? They're like, I don't know, just because I need some more money.
Exactly. Well, that was, honestly, like, I'm sure you saw all those OMs back in, 22, 20, from 22 to 24, really. Everything was, this magical pro forma that was being put together, and you can charge this fee, and you're going to get, if you build covered parking, you're going to be able to, increase 50 to 75 bucks a spot and this and that. And I think we probably put the financial crimp on some folks with all these additional fees and value adds that we ended up charging them for, right? But I love this particular deal because you found value just through like prudent financial management and shopping around, right? Is that what you and Align Ventures considers value add, or have you done projects where you're going in with a medium or heavy lift CapEx strategy to raise rents?
Yeah, definitely done both. One of the last deals we did was a heavy lift. We bought it from an owner. He's owned it for 30 years, neglected it. Almost every unit needed touched. And it was a lot of blood, sweat, and tears, to get it up to par. It looks great now. It's doing very well. But ultimately, we ended in the same spot that we were on a deal that we bought right and made all the operational efficiencies, right? With far less, blood, sweat, and tears there. So I think it's definitely a path there, for the right guy. If you like getting in and doing all the work, but I do think there's a lot more risk there as well, because at the end of the day, you're deploying a lot of capital into that market with the assumption that market's going to accept it at that rate.
Yep.
Right. Even if you have to drop $50, your ROI drops significantly on that. And, and like you said, we're not seeing a lot of rent growth. If anything, we're flat to slightly negative. Concessions are up. So, and when I see a value add plan right now, and, other guys pitching deals, I'm like, oh, good luck. I hope it works out. But it'd make me nervous going into a market and saying, yeah, they want an extra $200 a month in rent for a nicer place.
Mm-hmm.
Because what I'm seeing is, even on some of our C assets where we renovated half the property, as we're having turnovers, we're keeping, a percentage classic. And we're just re-renting at the lower rate because we're seeing more demand for the affordability right now than the nicer product.
Yeah.
So yeah, we're definitely, when we're looking at deals going into this market now, we're trying to find more operational plays, cost savings plays, opportunities to create value without spending capital. I think that's, the best case scenario. Definitely there's always going to be like a CapEx component, right? You're going to add some amenities, new signage, all these things that make it a little nicer place to live. And that's the fun part. I think when you're giving them something and you're not really asking, you're like, you guys need some pergolas. It's hot out here in Texas. Like,
Yeah.
let me give you some shade, some picnic. We want you to like it here.
Right.
And so that's great. But, when you have to have an ROI on all the other things that you do, and obviously that's taxing the resident, I think it gets a little dangerous in this economy.
I completely agree. I couldn't agree more, as a matter of fact. Two things I wanted to touch on about this acquisition. So we've heard repeatedly, and we've talked about a number of times on the show, that raising equity in this market can be challenging, and financing's become a challenge. And our guest last week, Nick DeLeone, had pointed out that just in the last 50 days or so since this conflict in Iran started, that agency debt's gone up 75 bips, if not more, because of all this concern and ambiguity in the market. So how did you guys find the raise, and how did you guys find the financing components of the deal?
Yeah. So even before the increase in basis on the deal, agencies have really tightened up. We started with Freddie. They weren't willing to give enough LTV to make it make sense. So we went to Fannie, and they ended up giving us a really great deal. We worked with the Berkadia team. They were fantastic, fighting for every dollar. So we ended up getting great proceeds on this thing. We rate locked at the right time. We got a great rate, but they definitely have upped their requirements. They want to do thorough inspections. They really want all the documentation. So it was definitely much more of a process than it has been in the past. Mm-hmm. Right. I think they saw a lot of default and, with those 21, 22 deals. So they really, tighten the reins. So that's for sure. If you're going to get agency debt, you're going to go through the process. It's going to take at least 60 days, if not longer, to get that through their whole system. Yeah. And then as far as the rates go, I think economically, obviously right now we're seeing the rates tick up, but I do think they'll, when things stabilize, tick back down a bit. Yeah. I'm not upset at the rates. I think that what we saw was a reset in the market cycle, right? Obviously we were at an all-time high, 22, early 23, and now we're seeing deals that are 25, 30% discount to that, below replacement cost. And the rents, they haven't come down. Like you said, they're flat, maybe just a little bit. So, but you're able to get a 6.5 cap on the right deal. So if you're able to get, debt at 6% even, you have positive yield day one, so if you do fixed debt and you have a plan to increase that NOI, that's a great deal. So I think there's plenty of those out there right now in the marketplace. So
that's awesome. That's awesome. So are you guys back on the hunt so quickly, or are you going to take a break and operationalize first?
Well, so we did this deal a little backwards. So we're really well capitalized as a group. So knowing that the raise is difficult, we went ahead and closed this deal. We had a handful of investors come in with us, but primarily using our own equity.
Nice.
And right now we're backfilling that equity. So we're about, a little over halfway there. So we're still raising, and we want to get, about 3/4 before we hit the market again. So we could copy paste that method. I think, it's fantastic for the investors, especially on this type of operational play deal, where we can say, hey guys, I know you're a little gun shy. You had some bad investments maybe on these 21, 22 deals. To mitigate that, this deal is already closed. We've already added $7 million of value to it. It's cash flowing day one. Come on in.
Yeah.
So um, definitely seeing hesitancy from investors in the market. They're a little, adverse, to multifamily, but, just trying to educate, say, it's cyclical. We got a great deal at a great price, fixed
Mhm.
rate debt, some of the learning from other people's mistakes, always helps,
Yeah.
don't go adjustable, which I don't think anybody's doing right now, unless it's, even if it's a not stabilized deal, people are putting caps on, which also with this conflict, I was just talking to some lenders last week and they're like, yeah, the caps went from 75,000 rate cap to now 300,000. It's like
Wow.
they've spiked.
Yeah.
So I think that's going to make it a little bit harder to get more deals done right now during this conflict. So if it's not a stabilized agency type deal, we might see even further discounts on pricing from those, which, everything can work at the right price.
Yeah. Yeah. I think we've been talking about this, feeding frenzy that everybody's been predicting. And
Mm-hmm.
I think it's going to become very, very real in the second half of this year. And I think I'm seeing a lot more lender-owned deals hitting the market lately. There's still
Same.
plenty that are happening, very, very quietly. And there's plenty of deals out there that are, just kind of on lender life support. But I think the oxygen's going to run out on some of those here, or a lot of those here in 2026. So we just got to be, in the right place at the right time and have our buy box really dialed in. You mentioned before, investor sentiment. So, how real is it, based on your conversations, that your investor pool has taken some black eyes or some bruises over the last couple of years with deals not performing the way they were expected to?
Oh, it's so real. Yeah, I think a good percentage of them, if they were active, in the last couple of years, they've seen below expected returns, big delays on the timeline, development deals, or even just some of the existing. What I've heard even the last week talking to some of the investors was, yeah, we were supposed to be out in 5 years, but now they're going to refi and they're going to extend. It's going to be 10 years just to get our money back.
Yeah.
So he's grateful that they're making it work and that the capital's still going to be there, but it's not at all what it was expected. And I think that's the main sentiment, is it's not what I expected. Right. Unfortunately, some did lose capital. There's been some wipes, like you said, the bank owned deals. They've been on life support and they are starting to pull back because, they'll say, let's survive till 25.
Yeah.
That didn't work. That didn't work for everybody. Right. So
Yeah.
now we're, well into 26 and the banks are like, I don't know, guys, we got to take action. So
Yeah.
I'm seeing that too. I'm seeing more deals come to the market. I think it's an amazing time to be a buyer right now. How long has it been since we saw deals like this, yields, like this? It's been 2008, 2009. It's been a steady track up. I think it's an awful time to be a seller. If you have to get out of an asset, that's the only time you're going to sell right now, really. So it's, but it's how market cycles work.
Yeah.
A lot of it's timing and
It
playing.
is timing. And look, it was so red hot for so many years that we had to, yeah, you have to look at this and say, this is probably needed and at some level expected. I think, there's just from an owner, operator, and investor perspective, the perfect storm is it's been a lot to weather, right? You got taxes and insurance, which went through the roof when insurance companies realized they could be charging 40, 50, 100% more than they had charged in years past, and somebody was going to pay it, right? Or force place insurance at that cost. Cap rates decompressing, the combination of stagnant rent growth and cap rates decompressing as much as they have been has had its fair share of impact. But to your point, right? Like, if you don't have to sell right now, don't, right? Because
Exactly.
there's going to, just as supply hit the rental rates over the last couple of years, I think we're seeing inventory supply, whatever you want to call it, right? That's certainly going to suppress actual transaction pricing between now and the end of the year. So if you actually don't have to sell and you can weather the storm, just keep it moving, keep swimming, right? Let's go with the Finding Nemo reference and just keep swimming.
Swimming. Yeah, I couldn't agree more. You're right, and I do think it was the perfect storm, which it kind of accelerated that reset. It probably could have kept going a little longer, but I think it was needed. Things were
Yeah.
getting a little out of control. I mean, we didn't even buy a deal in 23 or 24 because we're looking at the deals and we're like, this makes sense at this rate. And we got outbid substantially, millions. And I'm like, there's no way. How would they make that work? And they're just, you know, they're assuming that things are going to continue to go up, rent growth year over year over year. And it's like, at some point that has to break. It
Yeah.
just does not make sense. So this reset has allowed us to come back in and buy at a real basis that makes sense now. Right. So now we don't have to jack rents up 20% over a 5-year hold to make it work. Now we can say, hey, we're going to, go flat the first year and maybe 2.5%, 3% each year to grow with inflation. And that works on this deal,
Yeah.
which I think the renters need that break just as much as we do as the owner operators. Right. Because they're like, I don't have the money.
Yeah.
So yeah,
Yeah.
needed reset in many ways.
Agreed, 100%. So how have you and the rest of the team adjusted your underwriting in this kind of new world that we're in? You took a couple of year break from looking at deals or buying deals at least. Sounds like you didn't really take a break buying. You took a break buying overpriced, right? You were waiting for
Sure.
someone to come to you. So how have you adjusted underwriting and deal due diligence?
Yeah, I think it's definitely you have to change, you have to shift. You have to see what the market's calling for, not only on your side, but what are the deals everybody else is doing, right? I think that's good to see. Look at the recent deals that are closing and what they're offering and how they're looking at them, right? Because you can learn just as much from others, just like I'm talking to you guys now, right? So I
Yeah.
think it's rent growth. Obviously, you have to be very cautious there. Rent, especially if your rents are already higher or mid market, right? So we've really reduced any aspirational rent growth, which we never were that strong on it, but we're usually leaving year one flat just to give it some time, acclimate to the market, and then, small growth, like I said. I think taxes, we were underwriting them with really big escalations. We're still going really close to purchase price, year one takeover. But then, we're not necessarily underwriting 10 or 15% growth on that, 5%, keep it realistic. But we've had a lot of success also disputing and lowering our taxes across the markets. So I think you can't argue that case that values are not what they were in 21 and 22. And the auditors, as much as they want to fight it, it's like, no, guys, we could show you financials, what we're grossing, and it's not what it was.
Right.
So I think that's definitely an adjustment. We are on materials, right? Repairs, we're escalating those, growing those because we want to be sure we can, we're not undershooting our forecast because everything's more expensive, right? So you might have to go 3.5%, 4% on materials, repairs and maintenance stuff. And then we're being a little bit easier on insurance. We've seen reductions and savings, year over year on those. That one, not too optimistic because one major storm can upset that whole plan. You know what I mean? There's a delay on it, but eventually they're going to get their money back.
Yep.
So we've been fortunate to not have anything, past couple of years. So we're seeing that break in rates right now. Some more companies are coming back into the market. Where we had people leaving Texas, so you had limited options. So that's opened back up. So, but that's really it. And I think the biggest thing is just being very pessimistic on occupancies.
Yeah.
Right. I think the market's a little softer right now. You're not seeing, huge expansion of households. You're seeing, maybe a constriction even. So you're having to fight more for those residents. If the market's giving concessions, you're going to give them too. Right. So plan on it, put it in your underwriting. So, and then I think the last point that we've really learned from 21 and 22 and looking at other people's failures is capital reserves. I think, we didn't necessarily initially have much in there. We always had buffers, but now seeing these people get hit by unexpected things and having to fold because they ran out of money, or they're having to call in their investors for money. And that's one thing we don't want to do. So our thesis, we would rather have a deal that's not as shiny, home run return wise, and have built in operating reserves. So 3 months of, full reserves should anything happen, an extra couple $100,000 in CapEx should anything happen, right? So we have, about $500,000 sitting in an interest bearing account, but it's not contributing to that deal. It makes all your numbers tick down a little bit, right? And that's fine. And we would rather do that and be safe than sorry, which, you've seen it, because the one thing that's going to fool the deal is lack of capital. Right.
Totally. You gotta keep the lights on long enough to recover, right?
Exactly. Yeah. So I think that's one of the biggest takeaways.
Nice. Lots of lessons learned there. Thanks for the detail on that, Tyler. How have you, what's, a couple of years ago, it was like when you're underwriting a reversion cap, it's take the entry cap and, add 10 or 15 basis points for every year you intend to hold the deal. How has that changed, if anything?
Yeah, I think it's a really interesting time. And that's a nuanced question. I think it depends on your deal. It depends on the market, depends on a lot. So, we're favoring kind of a flat cap right now because I feel like we're buying high right now. And I'm looking at supply demand trends, Houston specifically, Houston, I mean, we're typically producing 20,000 units a year, new inventory. This year we have 9. So we've seen a supply, kind of the supply cliff fall off, but we still have really great in-migration numbers. Population's growing dramatically. We're bringing tons of jobs to Texas. I just saw Caterpillar's moving their headquarters from California to Texas. It continues just because we're a very business friendly economy, politically, it makes sense. Mm-hmm. So I think as the supply demand, we see the new inventory get absorbed. It creates more demand for the existing assets. There's not as much new inventory to buy for investors. They're going to turn more towards the existing assets. So hopefully we see more organic rent growth again, higher occupancies, if nothing else, just out of sheer need, right? So I see, as far as a hold period, 5 years from now, I think we're sitting really good if you buy assets today. So I think we should be able to have a flat exit. I don't necessarily see, I think the interest rates skyrocketing more is the only disruptor that could really shake that up. Mm-hmm. But economically, I don't know if they could handle that. Right. If you have 10% rates, everything's inflated, incomes aren't growing like that. How can anybody do anything? It stalls your economy. So I think, at some point they have to step in, buy bonds, do whatever they need to do to keep the rates, kind of in the range they're at now, given we're not at war forever, Yeah.
Oh, let's hope not. Hopefully we definitely don't need another eternal conflict for sure.
Agreed.
Awesome. Thanks for walking us through that. So I'm curious. So, and we talked a lot about, the upfront value add on this deal being, largely financial, right? But how have you and the rest of the team adjusted your operational strategies in either with the deal that you currently bought or just overall as you've kind of navigated the last couple of years and, bringing in your background as someone from the property management space?
Yeah, I don't think we've necessarily changed our operational strategies. We've always been very cost conscious. Me, it's all about that NOI. I have that operational mindset where I'm like, hey, there's a cause and effect for everything. And also, I would say it's, don't save a dollar at the cost of the resident. So and I think a lot of people did that where they got too much into the AI or automation or the technology to where they were doing, virtual tours, they cut their staffs, and they went too much into that NOI direction. We're like, we could automate everything. And at the end of the day, it is a service business, mm-hmm. operating a property where you need to handle their concerns with care. It's their home, and you need to be there for them if they need you. So I think, not going too far in that direction, but being able to save where you can, where it makes sense, like materials, right? And even using AI as a fantastic tool to do that. So that's something newer, as AI has grown and improved, that I've really loved to do, is to just throw my operating report into AI. You have your GL report, which is a breakdown of every code, every purchase. And I say, hey, within our assets, what are we buying the most of? What are our top purchases? It'll say, hey, you buy, 1,000 of these air filters, you buy these light bulbs and these locks. And I say, okay, what are we paying per? Right. And I get a breakdown. Can you search the web and find vendors that can beat that price? Right. And they're like, yeah, this will save you, $2 per item if you go here. And then I could contact that vendor and say, hey, I'm buying 1,000 of these. Can you give me a better price than what you have online? And a lot of times they'll say, yeah, we could work with that. So then you're saving $3 per item, 1,000 annually. So you just save $3,000 one item over your portfolio. So I think leveraging AI more to spot things, and even with our monthly operating statements, I'll go through it in detail, write an executive summary out. But then I think it's great, right? I spent a lot of time and thought, I put it in there. I'm like, what did I miss? How can I make this better?
Yeah.
And there's always something that it prompts me. It's like, hey, did you think about this? Or I noticed this trend here. And I'll be like, wow, that's such great insight. It allows me to be better, make better decisions by leveraging the supercomputer to see the things that I might have missed.
Yeah, I love that. And I actually have been using AI a lot on, investor updates as well. And I actually just wrote one last night. So February and March were interesting months for us. We had like a big water deposit that we got back, and then we had the down payment on our insurance policy come out, which kind of skews the financial a little bit as one time. And like I just told Claude what happened and said, go normalize the financials for the last 6 months outside of these one-time occurrences, and seconds just came back and like knew the math, established trend lines, help me explain that in the language of an investor. And it's the augmentation that AI is providing right now is unbelievable. I did want to circle back on something because I want to get your thoughts on this. I agree with you about kind of the over automation inside of multifamily, which in my belief is still very much a person to person business, right? You're
Absolutely.
you need to build the relationship with the resident, and you're taking care of their family, right? It's super emotional.
It is.
And one thing I want to like pull apart on that is automated tours. So where you have a lockbox on a door, customer can, resident can go online and pick out the time they want to do their tour, and they upload their driver's license. I'm very conflicted on whether we should be doing this. What are your thoughts on that versus the traditional in-person tour with a leasing agent?
Yeah, good question. So I remember when I was looking for an apartment, and it wasn't even necessarily the apartment that sold us. It was the leasing agent, or just that kind of, it felt fun and excited, and I was happy to be there. And that's kind of what made the decision. So I think that option should never go away, right? If it's during business hours, should definitely be somebody there who's ready to tour, answer questions. And even if they did, I think after hours, because a lot of times on a property management, you work the same hours as the customers, right? There's oftentimes Saturdays, not always, but, so I do like the idea of more of like an after hours, like a window from like 6 to 9, where it's like, hey, you're busy. I get it. Go tour. And then let's get on a call the next day. And so you could still kind of mitigate that with that personal touch, answer the questions and build a rapport, but it is a convenience. So, and I think it's all, again, coming back to that NOI mindset. It's like, well, how often are you using it? What's the cost of this software? Does it make sense? If you get, one lease a month, but it costs you $500, is it worth having?
Yeah.
So it's really a question of, the need versus a cost. But yeah, I think as long as you balance it with that personal touch, then it's a good tool.
Yeah. That's a good perspective. I've always leaned in the thought process of an interaction with a prospect is a sales opportunity. And,
Mhm.
using your example, right? If you have a great leasing agent that presents well, presents your property well, can start laying that relationship deposit, there's no shortage of choices for residents right now. And, they could look at two almost identical B class properties inside of a mile of each other, and it's still within, the school district and stuff. The
Yeah.
person, in my opinion, that sells that property more effectively and starts to build a relationship with your prospect is probably going to be the one that wins. I just have a lot of heartburn on these automated tours, and I don't know why. Maybe it's a limiting belief, but like giving somebody access to, a workforce housing community where they can go in and who knows, maybe they need a dishwasher and they just walk out with your dishwasher, right? And the driver's license they gave you was fraudulent anyway, so who gives a shit? But like I just worry about like the edge cases there, and does that one bad apple spoil it for the entire basket?
No, I agree. You gotta be cautious when using it. It has to be the right property and, identify a need. If your occupancy is great and you're not having people requesting after hour tours or whatever, then, stick with what's working. So,
Yeah.
and then limiting beliefs, little Tony Robbins there.
Yeah.
I love that, man.
Try and drop a little Tony as often as possible.
Yeah, yeah, good knowledge. I like it.
Yeah, I went to a Tony Robbins event in 2019, and it was a life-changing experience. So listen, we're starting to come up on time here, Tyler, and I want to be considerate of your time. This has been awesome. So there's two things I want to dig into before we wrap up. Number one, in preparing for our chat today, spend some time on your website. Great website. What I love about one of the things that jumped out at me is the pride that you guys have into how well funded you as a deal sponsor and deal team are, right? I think there was a lot of folks out there over, for the last few years that, were deal sponsors because it was cool, didn't have a strong balance sheet, didn't have the liquidity to survive, so on and so forth. I love that you guys put that front and center. And I don't think it's chest beating. I think it's more from a reassurance and credibility perspective. So, how does that resonate with the people that are coming into your investor funnel, and how much strength does that give you in the marketplace when you're negotiating with brokers and or lenders to get deals done?
Yeah, well, thanks for bringing that up. I think it's when it comes to investors and it is really how we feel about it. I think it's really hard to be aligned with your investor if you're putting in the minimum and your fees that you're taking from them equate to that, right? Because in the day you got paid out. Like, what do you got in it? What's your motivation here? We are investors. We're the biggest investor in every deal. So, and what they say is true. Nobody's going to look after your money like you are.
Mm-hmm.
Right. So we have the ultimate motivation to ensure these deals succeed. And when we explain to investors like, hey, man, I'm an investor too. I've sat there, I've looked at deals and we're investors in this deal. And when my money sits right next to your money, it doesn't have any protections. It's neighbors to your money. Right. So I think that helps them just understand that, okay, these guys aren't selling me something that they don't believe in, that they are truly invested in this.
Mm-hmm.
So that it does help. It does bring some comfort and credibility, I think. And we really try to lean into that because true belief is that I do think that is the ultimate alignment. So, and in regards to the brokers and the lenders, I think it definitely helps. This most recent acquisition, we went to best and final. We weren't the best price, but we did send them a video, said, hey, this is our balance sheet. We're going to close this deal. We don't have to wait on investors. We know everybody's challenged right now, raising the capital. A lot of deals are falling out. We're willing to give you a great price, guaranteed close, and they selected our offer because of that. So it allows us to come in and be super competitive with our pricing, and give some comfort to the seller, because we, like I said, we were best and final on quite a few few deals this last year, and I can't tell you how many of those deals have came back to me and said, "Hey, they couldn't close. Are you still interested?" They're
Yeah.
like, "Oh, I mean, I might be not at that price that it was."
Yeah.
And no seller wants to remarket. It's a worse look, right? So that assurance of close is huge for them, and it does buy us a discount, which in turn, gives our investors a better opportunity.
Love that. That's awesome. And I think that your credibility, your company's credibility jumped out at me, like smacked me in the face, getting into your website. So kudos to you guys. And
Thank
by
you.
the way, we're total believers in everything that you just said. We put our money into every deal that we've done. We actually, we realized, talk about a goofy moment. So we did a deal 2 years ago and we have, 4 GPs on it. We didn't even take pref shares, right? The four of us put individual money in it. And like we could have aggregated our money, started a new LLC just to get pref, and we didn't. And
Okay.
like we're out there earning it every single day, and I think you got to have skin on the game. If you don't, there's really no incentive that when times get tough, you're going to stick with it. And it hasn't been sunshine and rainbows every day for a couple of years now.
Yeah, great example. I agree, man. That's it. And you should be out there fighting for it every day. Like,
You gotta.
because it's like,
This is a third
I'm
of your
protecting my livelihood too.
yeah.
I got these other guys, which makes it even more important, but you're just out there and you got to do it. And I think some of these deals that are, like we mentioned, some troubled deals in 21, 22, these guys, the ones that are they're fighting for it. They have money in there too. Like they're making it work. They're figuring out a way. It's
Yeah.
Tony says not a lack of resources, a lack of resourcefulness. So I think when your money's on there too, like you're gonna figure it out.
Exactly. Exactly. All right. My last question for you, Tyler. This has been fantastic. So you completed a deal. You're backfilling your investments right now. What does the next 18 months or so look like for Aligned Ventures?
Yeah, I think, like I mentioned before, it's just a really good buying opportunity out there in the market. You find the right deal, the right basis, the right story, and yeah, I think now's the time to grow your portfolios. Right, it's the best numbers I've seen in about a decade. And I do believe in multifamily as a long-term investment, an alternative investment. We're seeing the stock market's been doing really well for a long time. Historically it resets every 7 years. So, we're just trying to go out there, find deals that we can put our money into, diversify ourselves, and help investors find another vehicle where they can have a good solid asset that's just not being oversold to them, right? So that's really the goal, is to take down, grow to $1 billion portfolio over the next few years, and do good deals. That's really the core of it, man.
I love that. I love that. I hate to do this to you. I'm going to ask you one more question just because something that you said ignited a familiar conversation.
That's good.
So one of the things that I've observed over the last couple of years is there's a lot of deal sponsors that did a bunch of multifamily, right? And then started to get shiny penny syndrome over the last couple of years. Businesses, different types of asset classes,
Yeah.
so on and so forth, right? And to more power to them. I think personally, I think it's difficult to continue to build credibility with investors that you could potentially look to raise from downstream if you're not consistent and focused in your investment thesis. How has it been difficult to stay loyal to multifamily as an investment vehicle, or have you guys considered other asset classes while multifamily works itself out?
Yeah, good question. I mean, and it has been a challenge a little bit because you go to the conferences and everybody's like, "Oh, self-storage, man, that's where it's at." We're all jumping over here and we're like, "Sounds good." I don't know, but I do, we love sayings, right? There's always some truth to them. So, jack of all trades, master of none,
Yes.
Right. And so I really believe that, multifamily is what I've spent my career in. It's what I know. It's what we're good at. So we're going to stick in that lane. So what we did when everybody was jumping is like, let's double down. Let's create more efficiencies. Let's build a stronger base so that when it is time to scale, we're ready to dive in full speed and take advantage of it. So that's what we did. It wasn't glorious. We weren't, riding all these different waves. But now that we're at a position where multifamily has a lot of potential, it's a good time to buy, we're ready for it.
Yeah. Love it. Awesome stuff. Tyler, this has been an amazing conversation. I appreciate you spending your morning with us. I think our listeners are going to get a lot of value out of this. Tell everybody where they can find you, and I'll let you go. Get on with your day.
Yeah, it was a pleasure being here, Matt. Great conversations, man. Check us out on our website, investav.com, or find me on LinkedIn. Yeah, I'd love to talk.
Awesome. Everybody, thanks for listening. If you like this episode, go hit the thumbs up button or the subscribe button on whatever social platform you're checking us out on. Tyler and I are going to go do chest day right after this and do like 400 burpees before we call it a day. So Tyler, awesome. Dude, let's keep in touch. I think you're going to be at IMN in a couple of weeks.
I'll be there. Yeah, let's connect.
Yeah, let's definitely catch up live. I think we're doing a dinner or something. Make sure you get the invite. But really appreciate you spending your morning with us. Great episode. Thanks everybody for listening. We'll be back in a couple of weeks with our next show and try and top what we got going on with Tyler. But I think that's going to be difficult. Tyler, thanks for sharing your story with us, brother. Have a great day.
Take care.